Whether you are a beginning investor or an advanced investor, wouldn't it be great to have the right knowledge to not, or you didn't have to make any mistakes or lose money? Well, hopefully this could help you. Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, helping you make some real money so you could start living your real life. And in this video, we're going to be going over 26, just because I wanted to, 26 investing tips that we could all learn from, and that I've learned from just learning from other people, from reading, from millionaires up to even billionaires, and we could definitely all learn from this. And by the way, I am not a financial advisor, so please continue to do your own research. So getting right into it, guys, with number one, something simple and very important by the man himself, Warren Buffett. Rule number one, do not lose money. It seems so obvious, but it's actually more important than we even imagine. There's another tip down the line that we'll go into it a little more. However, just the idea of, let's say you get a 50% return, right? Let's say you have $1,000, so now you have $1,500. Now when you lose 50%, you gain the 50, right? But now you're losing that 50, you're at $750. So you're actually losing more with the same amount of percentage movement, and it takes more to return to get back to where you started. So that's why losing money is so important. Investing tip number two is risk and reward isn't always necessarily hand in hand. And you probably have heard that with more risk comes more return. And overall, that is true. You know, let's say looking at stocks, a little bit more risky, more return, comparing it to, let's say, a savings account. Very low risk, but that's a low return. You can set yourself up in the correct way that you can get a good return with relatively low risk. One simple example out there could be, let's say, if you got into basically any type of investing in 2008. Just because it was kind of a crash, but just because it was a low time, it was really low risk, because then everything rebounded from there. That's just a simple example, but there are other ways as well. Number three, which is from the man Jack Bogle, very smart investor, the founder of Vanguard. And if you know anything about him, that is minimize your fees, because when you minimize your fees, you maximize your returns. Fees eat into your returns, and that's an issue, which could easily lead us into number four. Passive investing usually does better than active investing. Going back to Jack Bogle with Vanguard, simple index funds. Definitely do your research, of course, but research has shown that a simple index fund or passive investing, set it and forget it, will outperform a lot of people trying to time the market to get in and out. Now, before getting into number five, if anything comes to your mind thinking of how you became successful in investing or heard something to add to this list, definitely leave them down in the comments so everyone else could learn from it. But number five is, just because you picked a great investment, or if not the best investment, you could still actually underperform. And an example for that, there was a fund called the Magellan Fund. It did very well over decades. However, the holders or the investors in this fund actually underperformed the market. And the reason for that is because emotions take over. You try to get in, you try to get out, you try to just avoid all the issues, and then if you held it, you actually would have got that, but most people did not. Number six, which actually has nothing to do with finances, ironically, but you really have to understand human biases and psychology. People are investors. We're all humans, we're all emotional, whether we believe that or not. So when things are going bad, we panic and we could sell at the wrong time. We could also buy at the wrong time. So there are so many different biases, like when you have a decision, you think you're right, so you're going to hold on to it. Or anything else, you try to just kind of sway toward one way. Also with psychology, a mental thing, because we are emotional. So once we actually understand how humans work, you could understand how investing works even more. Number 7, which is very, very important, which is diversification. Of course, a lot of people have heard, don't put all your eggs in one basket, but the idea is not to only have stocks, and not to only have bonds, or even both, because there are a bunch of different assets out there. Don't only have some in your country. You could have international investments as well. You could get into real estate. You could even get into gold. But have a bunch of different things out there so you're not only focused on one thing. Which could lead us to a very smart individual. But number 8, we're talking about to really focus on the downside versus the upside. Try to limit your losses. And we're going to be talking about Ray Dalio. He has his all-weather portfolio, and like we just said, diversification. He has a bunch of different assets. So let's say something goes down, he has something else that goes up. He's constantly in balance. So again, going back to rule number 1, do not lose money. This will help you. When you diversify correctly, you actually limit your downside. Now, number 9, if you've been investing for any amount of time, you probably have heard timing the market probably doesn't work. And you probably also heard that time in the market is better than timing the market. I like to use a couple different examples. If you're old enough, let's say when the market dropped, 2008, did you get in at that point? Well, if you didn't, then you timed the market incorrectly. If you're into, I like using the example of Bitcoin because they had huge swings, but it hit almost 20,000. If you're interested in Bitcoin, personally I'm not, but it hit 20,000. Did you get out at the top? And then it dropped down to close to like $3,000-$4,000. Did you get in at the bottom? If you missed both of those, you didn't time the market correctly. Number 10 is very important, which is subscribing to my channel. Hopefully I could help you out there. But the real number 10 is you should really only invest in individual stocks if you have the actual time to do research into them. It takes a lot of time to go into the financials, into the fundamentals, into the news, into the reports, into the conference calls, and all these things. And if you don't have time to look into that, you're essentially investing blindly. Can you make money without doing all that stuff? Yes, but that's risky. So if, let's say, if the stock drops, you're not going to know why. You're probably going to sell out at the wrong point and lose money. You essentially have to live, breathe, and sleep investing in stocks to actually know what's going on. And even then, it's still iffy. Number 11, which would be to, well, ironically, because I'm telling you this advice, but follow no one. But always be observant and be open to what's around you. So I'm not telling you to like buy individual stocks. However, you should be open to what people have to say. Do not follow anyone. Don't follow just like the news to buy when they say buy or sell when everyone else is selling. Or you heard from someone, this is the next hot stock. Most likely, it's not. And that's why you have to do your own research. And number 12 is the exact reason why number 11 you could screw up on is past performance does not always equal future performance. So for example, like let's say the latest hot stock or something that just flew up last year most likely isn't going to continue that for this year. So that would lead you to end up buying high it's not going to perform well this year and selling low. So that's definitely an issue. Number 13 is know the difference between investing and speculating. There is a difference. So a speculation is just betting and hoping that the investment, could be the stock, could be really anything, is just going to go up and that's it. Can you make money that way? Absolutely. I'm not saying speculating is a bad thing. However, there's a difference. Investing is into something that it's an income producing asset. It could have dividends as well. There's something that drives that price essentially. Number 14, something extremely important. If you haven't heard of it already, I don't know where have you been, but this is, you gotta follow it, is compound interest. This is just over time. Your interest gets more interest and grows faster and faster, growing exponentially. That's how you could become a millionaire, if not a multi-millionaire. Unfortunately, it takes time to do this. If you're still with us so far, thanks for keeping around. But for number 15, which a lot of people don't realize, I just learned this recently actually, there's a huge difference between average returns and actual returns. And the difference between that, I kind of had an example toward the beginning, and I'll say it again. So let's say you have a positive 50% return. Great return. Then the next year you have a negative 50% return. That average return is 0, right? Because you're up, back down, you're back to where you started from. Percentage-wise, not dollar-wise. If you actually plug money into that, let's say, going back to our example before, you're starting with $1,000. 50% return would rise you up to $1,500. Then a 50% drop after $1,500 would be $750. That's not a 0% return. That's actually a negative 25% return. That's why losing money sucks so bad, and that's why the actual return is different from the average. Number 16 investing tip would be understanding your time horizon. Meaning if you need money like within the next year, maybe even 2 years, you might not want to be at least heavily invested into the stock market, because stocks could swing. It could go lower, there could be a correction, there could be a crash, there could be really anything that goes on. So if you have a time horizon that's like 5, 10 plus years, even if something does happen, it has time to rebound and you make money from that. So if you're really looking to save for the short term, stocks shouldn't be your only option. Definitely look in other places. Now number 17, it's a little touchy. I'll throw some controversy out there, but a lot of people believe that the stock market is manipulated. There are things that lean toward that reality. Just to throw facts out there, the Federal Reserve is actually a private company that actually has a trading desk. Think about that. Also, kind of like share buybacks. If something drops really heavily, the Fed or even share buybacks could hold that to a certain level so it doesn't drop so far down, it keeps it up. And just one interesting example that I'm recently learning is with gold and silver. The price of gold and silver is actually derived from the derivative of gold and silver. Most things, the derivative is derived from the asset. So basically people are just kind of manipulating gold and silver prices. Just something interesting to think about. Number 18, we're getting into some taxes, and you should understand the difference between short-term and long-term capital gains tax. Short-term meaning within a year, so if you buy a stock now and sell it next week, next month, few months from now, you get taxed in the short term, meaning whatever your normal income tax bracket is, that's what the tax rate is. When we're talking long term, which is more than 1 year, you are taxed at a lower rate rather than the short term. So the range of taxes that you'll be paying, depending on your tax bracket, for long-term capital gains is between 15 and 20%. Sticking with taxes, investing tip number 19 is realizing that dividends are taxed differently than your normal income and also capital gains. So dividends are taxed lower, and kind of similar, it does depend on your tax bracket. However, it goes from like 15 to 20% rather than your normal income tax rate. But do watch out for dividends, because if you are invested in a DRIP, a dividend reinvestment plan, yeah, you get those dividends and you reinvest them back into the investment. Makes perfect sense. Do realize that although you do not keep those dividends, you still get taxed those dividends, as long as they're not in a retirement account. So you're going to have to owe taxes on money that you don't have from that. So just keep that in the back of your head. Number 20, kind of depends how you look at it, but let's say generally speaking, if you do wish to beat the market, you could look at, even Warren Buffett has said this, because he got so large, like his company, he's starting to move toward like normal market returns. When you're smaller, or like a small personal investor, you could invest in small and mid-size companies. And when you invest in those types of companies, they have larger growth. If you're investing in those, they have to be the right ones. Those reasons you can outperform the regular stock market. Number 21 is realizing that high frequency trading and like computer algorithms exist. All this is done on computers. The information is transferred so quickly, quicker than most people understand or even realize, and they just make trades off of it. Or let's say if a news article has a negative connotation, the computer algorithm knows to bet against stocks, and that's what exactly it does automatically. So that's why if some news article comes out or something happens in the government or with the president, that's why stocks become more volatile, because these algorithms are set up to move. They either buy or sell on that news. Number 22 can be used for your advantage. Anyone could take advantage of it, is dollar cost averaging. Simple idea. You could set it up with your retirement account. Chances are you're probably doing it right now if you have a 401k plan. The idea is just investing into a retirement account or an investment every single month. So no matter if something is up, if it's down, you're still investing in it. And over the long term, you're going to get out on all those gains. Number 23, which I didn't understand when I first started investing, but it is important, is to build up your position. So let's say you have, I don't know, $10,000. You're not going to invest the entire $10,000 all at one time, because it might not be the best time. There could be a lower time in the near future. So maybe you put in like $3,000, it might go down a little bit more, so you put in another $3,000. Or it might go up at that point and then you might want to sell. It really depends on your strategy. But when it does go down and it keeps going down, that could actually be great, because you build your position into it. And then once it swings back up, you get gains from all those entry points. Same on the sell side. You might not want to sell all at once. If it's at a point, you could sell there because it might go higher, and then you could sell the rest of your position at a later point. Getting to the home stretch here, guys. We're almost there with number 24. And that's having a cash position, so you can actually buy opportunities. A lot of people are asset rich and cash poor. So if an opportunity comes around, let's say a stock drops, it's a good buying point, but you have no cash. So that's why you do need a cash position, so that you could buy whatever comes your way. Number 25 that every investor and really person should know is the difference between a traditional IRA and a Roth IRA. So you could set it up, I mean, it depends on your company, but like a traditional 401k, which you probably have, is tax deferred right now, so you're not paying on taxes. When you retire, you do, so it grows tax free, and then you pay taxes at the end. A Roth is the exact opposite. You pay taxes now, and it grows tax free. Once you retire, you can take that out tax free. Depending on the person you are, you could use both of these to your advantage. A lot of people do like Roths better just because tax rates are kind of low right now, and you don't know what they're going to be in the future. Chances are they're probably going to go up, so we would rather pay lower taxes right now. And plus, when you retire, you don't have to worry about the taxes because it's tax-free at that point, so that would seem pretty awesome. And number 26, we got there, is no one knows the future. So you could see all these different people on all these different news channels, even on YouTube channels, that they might predict what could happen in the near future, and they might have things to back them up. You know, it might make sense. However, no one ever knows for certain that it's absolutely true, even on the news. In fact, if they say it on the news, it's probably the exact opposite. And at the same time, just realize there are business cycles. Ray Dalio had a report talking about this. It's actually kind of interesting. Every 10 years, there's kind of a business cycle. So it goes up and it goes back down. It goes up and it goes back down. And that's just how it works. So right now, we might be in a transitioning cycle. Last 10 years have been pretty good. Next 10 years, not so sure. So what do you guys think? If you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say. If you have any additional tips, if you lost any money somehow, what did you learn from that? I'm sure we would all love to hear that. So thank you so much for watching, guys. Really appreciate it. And I'll see you in the next one.